Good morning, everyone, and welcome. My name is Roger Ferguson. I'm a trustee here at the Peterson Institute, and it is my pleasure to be a host and moderator today for a conversation, first a speech and then a conversation from Chair Gary Gensler. Well, he obviously needs no introduction. I am actually going to then introduce him. And so I've known Gary Gensler for many, many years. He's had a long and distinguished career in the government. He was nominated by President Biden to serve as chair of our Securities and Exchange Commission on February 3rd of this year, or I'm sorry, 2021, and confirmed in April of 2021, and then sworn in April 17th. So he's been the chair of our SEC for a period of time. Prior to that, he was a professor of practice of global economics and management at the MIT Sloan School of Management, where he also was a senior advisor on the MIT Media Lab Digital Currency Initiative. He served from 2017 to 2019 as chair of the Maryland Financial Consumer Protection Commission, and he was formerly chair of our U.S. Commodities Futures Trading Commission as well. Prior to joining the government, and also he was a senior policymaker undersecretary in the Treasury from 1997 to 2001, which is, I think, where I first actually worked with Gary. But before that, he had a distinguished career of 18 years as an associate and a partner at Goldman Sachs. So he brings a wealth of knowledge. So please join me in welcoming and inviting Chair Gensler to the podium. Thank you.
Thank you so much. It's so kind of you. I did, as Roger said, we first met during the Clinton administration. And so when Peterson Institute had reached out some time ago to my staff and said, could you give a talk? I said, I'd be honored if Roger were there. No, it's true, Roger. I mean, just remarkable public servant you've got, and Roger over many years. Look, I have to note my views are my own as chair of the SEC, and I'm not speaking on behalf of my fellow commissioners or staff. I've gotten the formal stuff out of the way. Pro bono publico, for the public good. Where's this guy going, the chair of the SEC? Well, I'm going to start with Adam Smith, because you're a lot of economists. Known as the father of modern economics, noted in The Wealth of Nations, 200 plus years ago, that the whole economy benefits when the price of information is lowered and information is free. Reliable, comparable, accessible data benefits everyone. No one private entity, though, has the incentive to create reliable, comparable, and accessible data, even if they themselves might benefit. It's not in the incentive system. Thus, such data is a public good. And I think Franklin Roosevelt and Congress understood that setting up the SEC 90 years ago. But it's at our core. That great agency Roger helped run, the Federal Reserve, was set up for other reasons, but ours ultimately was about the public good and capital markets and disclosure. Nearly 40 years after Roosevelt set us up, George Akerlof published a paper, ended up getting a Nobel around this and other great work, about how market pricing goods face uncertainty about the quality of such goods. He discussed the used car market to illustrate the importance of disclosure. How do you tell between good cars and bad cars and so-called lemons? His thesis was that works just as well in the securities markets. Without credible disclosure, a market unravels. So now let me turn to another good for the public. My dad ran a small business in Baltimore, and if he got into trouble, couldn't make payroll on a Friday, the city of Baltimore, the state of Maryland, wasn't going to rescue him on Monday. Just wasn't going to happen. And whether it's my dad's small business or a large financial firm, this is good for the public. This idea that firms can fail. First, it helps promote the efficient use and allocation of resources and capital. And second, it better aligns incentives towards good economic outcomes. In essence, it lowers moral hazard. History is replete with times when tremors in one corner of the financial system, though, or at one financial institution spill out to the broader economy. And what happens then? Families, investors, businesses, the whole markets inevitably get hurt, And thus, around the globe, regulations and safeguards have been put in place to lower the risk of financial institution failures, all the way back, actually, to the Civil War days when the Office of the Comptroller of Currency was set up. But in the aftermath of 2008 financial crisis, there was a consensus to further enhance those regulations. And governments worked with financial institutions to create certain mechanisms whereby the private sector capital markets, and that's where this guide comes in ultimately in the job I'm in, the private sector capital market investors to bear the cost of failures through what's called loss-absorbing capital. In essence, in the face of potential failure, a large financial institution would conduct a major restructuring, recapitalization if you wish. But such restructurings and recapitalizations, they have not yet been tested at globally systemically important financial institutions. And it's 15 years. It's a good thing. We haven't had that tornado to fully test it, but it's not tested yet. And I think the goal ultimately is to protect taxpayers by having private sector investors bear the brunt of the cost of an institution's problems and not the citizenry, the taxpayers. That brings me back to the public good of disclosure. If a large financial institution's restructured, the markets need the disclosure doesn't go away. Some might think it does. It just simply doesn't go away. In fact, I believe the market's need for robust disclosure goes up. It's even more critical in the midst of that. I've lived this multiple times in my professional life. At Goldman Sachs, in the Clinton administration, in the Obama administration, in the Biden administration. First, I think disclosure is the best way to ensure that investors, counterparties, and depositors will have sufficient confidence to remain with the firm. Second, it's critical to addressing Akerlof's issue of lemons, the uncertainty of the quality of the financial institution, not only the restructured one, but also others in the system. Further, the time to best prepare for such disclosure is when there isn't a tornado. Thus, why am I giving this speech now? It's when there's not a tornado. The success of large financial institution restructuring, I believe, will be deeply dependent on addressing questions which will be on the community's mind. Now, who are these communities? Disclosures will be important certainly to securities holders, the remaining debt holders, the debt holders that are converted maybe into equity. But as critical, it's going to be important to the institution's counterparties, the swaps counterparties, the lending counterparties in the repo markets, securities markets, the clearing houses themselves. All of those counterparties are as critical as the investors. And third, the depositors, and particularly the uninsured depositors. And I'll give you a figure. It's not in my written speech, but the Bank of International Settlement puts out figures that the worldwide euro-dollar market, meaning dollar deposits in international banks, is approaching $10 trillion. And whether the number is 8 trillion or 10 trillion, you get the picture. These are uninsured deposits in international banks around the globe. All of these communities will be focused on a set of questions that can be boiled down to this. Should they stick with the financial institution or should they cut and run? It's not that. It's really pretty clear. I had to face that decision in 1995 as a partner at Goldman Sachs Japan when Barings Bank in London was on the brink. And I remember to this day the decisions that I had to make when my other partners were asleep. Well, it was pretty easy to me. I made the call that no money, no securities, no nothing was going out of the bank while I was awake and they were asleep to Barings Bank. And I didn't really think and stop to ask what the law was. I just said nothing's going out to Barings because it was a lemon. Now, by the way, we did not get sued afterwards. In the face of uncertainty and lacking updated disclosure, there's simply too great an asymmetry of incentives. On the one hand, if everything works out, investors, counterparties, depositors could get a return for sticking with the institution. Okay, a few extra basis points. On the other hand, if things don't work out, such parties may lose a significant amount of money. So the natural reaction, which is what I lived, the natural reaction is to manage downside risk, ring fence, and protect the house. I was there to protect Goldman Sachs and keep my job, too. I mean, you know, lose $10 or $20 million when a Barings going down, I think a few partners would have said, what were you doing? Further, other market participants will consider selling on the news. You know, short selling, it's a very important part of our markets. The use of credit default swaps in the midst of that, sell on the news. So in the absence of confidence on the parts of investors, counterparties, depositors, taxpayers in the official sector will bear the cost. It's really kind of this tension that exists structurally. And we policymakers have to think through that natural tension. How best that the capital markets bear the brunt, or is it the official sector and taxpayers? Contagion also will be readily spread without disclosure. What I'm saying is that transparency is one indispensable step in regaining markets' trust. Now, what type of disclosures am I talking about? At a minimum, upon the opening of markets on Monday following a restructuring, market participants will be seeking disclosures to the key questions that they have, and they're really asking this question: what's the risk if I stay in? Has the restructuring solved the problems that caused the institution to be a lemon? Based on financial sector history, by the way, it's rare that problems which lead to an institution failure were solely a liquidity issue. So no matter what management tells you, in the middle of the 08 crisis, Dick Fuld at Lehman might have said, it's just a liquidity issue. I can't sell these things. No matter what they tell you, and frankly, no matter what the official sector tells you either, market participants will be looking for disclosures addressing valuation, solvency, and viability. I mean, they'll consider what the official sector says, but I'm talking about the harsh realities of market participants. They'll be looking at valuation, solvency, and viability. Thus, investors, counterparties, depositors will want these type of questions answers. First, what's the restructured financial institution look like, including its pro formas for the restructuring, as well as the institution's judgment about material impairments or asset valuations, or should I say revaluations. To the extent of financial institutions' problems are related to assets, market participants will be looking for financial disclosure regarding adjustments to the financials. Look, absent such disclosure, what are the communities going to do? They're going to do a little bit like what I did when Barings was failing in 1995. They're going to be left with uncertainty about the quality of the counterparty, the quality of the assets that counterparty has. And they're going to be left wondering, how big was the hole? And has it yet been adequately filled? And no matter what that restructuring is, that's the question. How big is the hole? And has it been adequately filled? In essence, is it still a lemon? Second, what's the business narrative of the restructured financial institutions? Market participants will be looking for disclosures about what were the problems that got the institution into the mess in the first place. And further, what's the core business strategy going forward? It doesn't have to be a full 5-year strategic plan, but kind of what's the narrative that got you in the mess, and are you out of it? Or do you have a road there in some way? I think, thirdly, who's running the joint? Now, that's pretty straightforward. In the press I see in the room, that's probably going to lead an article, but that's not going to be enough disclosure. And then fourthly, interesting, what's the nature of government support, particularly specific to the institution? There's probably at that moment already generalized support, but what's happening and what's happening beyond the depositors? Even if the official sector might be providing liquidity, there's swaps counterparties, repo counterparties, and so many others that are thinking about protecting their own house. Look, the institution may not have all the answers on the weekend. That's known. But the more it lacks answers to the questions, the more difficult it will be for the restructuring to be successful. That's just kind of a structural tension in this system. Just as important as the information being disclosed is when it's being disclosed. My view, as a markets guy, the maximum way to be successful is get it out as Asia opens first thing Monday morning in Asia, the evening in Europe, the late afternoon here on a Sunday. I say this because usually crisis is, bailouts and all this stuff and mergers and everything is on the weekend. I mean, that was my experience when I was at the U.S. Department of Treasury in the Clinton administration. We were working through the stuff on long-term capital management, though Peter Fisher somehow got that all worked out on a Monday and Tuesday. We started on the weekend. Back to Akerlof just for a moment. His lessons are about signals. It's not just about the confidence in the institution being restructured, but I think it's also important about institutions to consider other disclosures. And we saw this just a year and a half ago after the Credit Suisse merger with UBS. There were still a lot of questions going around about other institutions. And those that put out additional information actually saw confidence regained in a number of those institutions. Otherwise, as Akerlof said, good cars may be driven out of the market by the lemons, and lack of confidence in one institution can spread to others. Now, I'm at the Peterson Institute. I know you mostly think about monetary policy, so I bring it back to Gresham's law. Bad money drives out good. Now, he was, of course, advising Queen Elizabeth I about money and monetary policy and bimetallism. But it rings true to me in the same way here. My main focus of the speech is public good of disclosure, particularly in the context of restructurings. During discussions, though, around financial institution disclosures with market participants, the SEC, sometimes me, sometimes staff, regularly is asked about what's required under U.S. law. Look, as important as the details of U.S. law are, and they are important, the goal is to have a private sector engagement, the private sector investors, rather than taxpayers, bear the brunt of a systemically important institution's restructuring. The best way to achieve that is through robust disclosures that meet market expectations, not just the legal requirements. So if you're in a jurisdiction that you can get an exemption or whatever, okay. But it's really about the markets. It's about what markets will demand in that moment. Nevertheless, I get the focus on U.S. law. I'm honored to chair an agency that oversees 40% of the world's capital markets. And we're only 22 or 3% of the world's economy. So we punch above our weight class. Of the 29 systemically important financial institutions, 19 are what's called reporting companies under the securities laws. Further, many of these institutions have subsidiaries that may themselves come under U.S. law, and those that aren't reporting companies likely are accessing our markets in some way. They're funding with swaps, they're laying off risk with swaps, they're in the asset-backed securities market, they're in the MTN market, et cetera, et cetera. So I get why they're interested in U.S. law. And to the extent that they're here, they do have to comply with U.S. law. First, that means institutions that are offering or selling securities must make sure their disclosures are not materially misleading. Sounds pretty straightforward, pretty important. Thus, to the extent the institution after the restructuring wants to access the public markets, they'll need to make material disclosures regarding the restructuring that just happened. Second, when offering or selling securities in the U.S., an institution must register the offering with the SEC. That's the first law that went in place, the 33 Act, or qualify for an exemption. The conversion of debt to equity itself is an offer or sale of securities. We've said that to international regulators around the globe. Converting debt directly to equity may have an available exemption under the 33 Act. But by contrast, if you convert debt to some form of interim right, which is what's done in some jurisdictions, and then that interim right later will be converted to equity, that may not meet any exemption. But again, my point of this speech is, regardless of exemptions, the markets are going to demand a lot of disclosure. Third, there's a requirement for current reporting. Now, in the US, you might know those things called 8Ks, that have to be put out in 4 days after material events. But again, my point is, you better be putting out information on Monday morning with a good clean presentation. Fourth, there's a requirement not to trade on material non-public information. Like, you couldn't tell this information to journalists, you couldn't tell it to some hedge funds and not tell it to the broader market, because people can't trade on material non-public information. You can't say, come here, don't worry, I've got some confidential information for you. Look, over the years, the SEC has engaged in constructive dialogue with regulators around the globe on how to think through their plans on this. But I think the key, and why I'm giving this speech, is also to say the time to prepare is when there isn't a tornado. And having personally participated, or have the agency participate in crisis working groups, when you're in the middle of a crisis working group, and these things come up, and the lawyers and the bankers and the management team looks at you and says, I didn't know I had to make any disclosure. I thought I'd give a speech maybe and sort of say, no, let's have this speech when there wasn't a tornado. I think that Congress has understood why you have to plan when there's not a tornado and set up a whole mechanism in Dodd-Frank to do so. I think regulators around the globe have implemented that, have enhanced it over the years and so forth. But given how important prompt disclosure will be in the success of such a restructuring, I think lawyers, accountants, management around these globally important firms really would be best to prepare for the disclosures the capital markets would need on Monday morning Asia time. And it's not an easy task. I don't mean it is. It is definitely not an easy task. And I think, though, that it's critical to think through and anticipate the disclosures, including not only what's legally required, but what the markets will most likely, I would say, demand. Think about who the teams are that are going to do it. Tell them they're the ones that are going to need to go to the bunker and do it. You know, just like in government, we have plans. Roger probably remembers this, kind of called continuation of government plans. You probably know at the Federal Reserve. You got to know who's going to go to the bunker and put together this disclosure. Look, the age-old need of disclosure, Smith, Roosevelt, Akerlof understood, creates a public good. It's relevant in normal times. It's relevant in stress times. Absent full disclosure, investors are left in the dark, relying on speculation, on rumors, unable to distinguish between lemons and non-lemons, and they're inevitably lean into protecting the house. I don't think there's any exceptions or exemptions or legal nicety about the animal spirits of markets hungering for disclosure, particularly in times of stress. Disclosure by institutions in the context of restructuring is integral to ensuring investor confidence, and I think it's the best way for private sector investors, rather than taxpayers, private sector investors, to bear the brunt of a restructuring through robust disclosure, even though that will be a hard task. So with that, pro bono, publico, and Roger, ready for your questions.
Take a seat up here. I'll join you from this side. So we've got about 15 minutes, 20 minutes for questions. At the request of Chair Gensler's office, he won't be taking questions from the press, but there's a press officer in the back to handle press questions, so he's right here.
Yeah, and I think we're going to do a press gaggle afterwards.
Okay, so the press will have your chance to probe a little bit. I'm going to probe a little bit myself. So, Chair Gensler, thank you for that speech. It was, as a PhD economist, Akerlof, you know, rings true, love it, great. Why now?
I am at the Peterson Institute.
I realize that. So why now? I mean, it feels, knowing a bit about policymakers, it feels like there's something in the back of your head that has forced you to give this very important and interesting speech. Is there some history, context, something that's driving you here?
I really felt make these thoughts known publicly when there's not a tornado. But I did live through that period of time with Credit Suisse from the kind of late fall of 22 to the spring of 23. And then, of course, there was the regional bank situation. And I found that SEC staff told me that over the years, not just during that, but for 10 years, we've been being asked about what disclosure is needed if a restructuring happens, and a particular keen focus on exemptions or exclusions. And I was struck by it as a markets guy, and I think, you know, I kind of core of who I am in my experience is markets, that the most important question was, what will the markets demand? Not the importance of the law, but what will the markets demand for there to be a chance? And as I tried to say, I think there's a structural issue. We've decided as great nations that the official sector and taxpayers shouldn't bear the brunt alone, that the capital markets should play their role. And so I thought, let's talk about it in a clear way when there wasn't a tornado. And I think this goes beyond the law, and it goes beyond who's sitting in a seat like mine or sitting in seats like Roger was in. The animal spirits of markets, which are just, they go to try to assess the data, judge the risk, and then, of course, trade on that. And I think absent the disclosure, these things are less likely to be successful.
Okay, so there was a statement in here that perked up my ears, and it was in great bureaucratic good speak, which is we've engaged frequently with conversations with international counterparts. Now, as a former regulator, I read that as not everyone understands it, not everyone agrees. So how does this fit in the world of international regulation, diplomacy, et cetera?
I think that there's a number of things going on. There's this structural piece that none of us can solve, that in the midst of a crisis, there's uncertainty. There just is. You get into that weekend and just don't know. Or usually it's like the weeks preceding that. And two, there's this law, like what's the US securities law? And of these 29 systemically important financial institutions, globally important, nearly all of them tap into the US market in some way. And I think we kept finding there's so much focus on the law, and I go, yes, but. So maybe this answers your question. And starting in the fall of 22, I just thought, I need to give this speech sometime when things are calmer.
So you put your finger on a tension, which is, if I were the GC of a major financial services firm and I'd heard you say we should be disclosing more, I'd also say, sure, but that's an invitation potentially for a lawsuit, because I'm going to, in a crisis, I may disclose something that turns out to be material, and I thought it was correct, but it was wrong in hindsight. And so aren't you inviting us to give information that could put us in harm's way in the private sector at this moment of greatest uncertainty when it's hard to know some of the facts?
Look, there are legal requirements that come down to this. Don't mislead the public.
Right.
Don't lie to the public, basically. You know, absolutely, and there's no way I'm backing away from that. That's what helps capital markets, that truthful disclosure. But you can make estimates, you can make judgments, put the proper words around it and so forth. I think, look, when you have less disclosure, you have more risk to have real jolts in the market. You have, for economists, you have discontinuous markets. And when you put that, better to put it down in your 10 Qs, your quarterly reports on a sort of regular basis, than have a jolt to the markets. And I think that when you look at these various crises, whether it was the 08 crises or some of the problems in 23, it was after the fact that you see who were the lemons and who were the non-lemons. But I would also say this, Roger, in terms of that crisis weekend, I think that if you came into Monday and you didn't disclose anything further, then you're putting almost all the emphasis on the official sector statement. What did the central bank say, the finance minister say in the moment? because the markets will be saying, I don't know how deep the hole was and whether they filled it.
No, it's fair. So I'm going to ask two more.
In essence, it puts too much pressure on the central banker and the finance minister. And, there's political economy in that moment as well.
Right. Yeah, I understand. I'm going to ask two more questions, and I want to turn to the audience. So, get yourselves ready for a few key questions from the audience. So here's the challenge, Gary, Chair Gensler, as I see it. You're right in theory that more information certainly is better. We have a regime here that you've just talked about, which is more accurate information is better. And yet you're calling for people, private sector actors, who are not going to receive any sort of immunity or protection from the government to disclose what could be inaccurate information at a moment of crisis, that weekend, as you describe it. So how do you sort of balance that? And I'm going to push it a little further and say, you refer in your talk to Dodd-Frank, right, which creates a workout regime, so to speak. Dodd-Frank, unless I'm mistaken, does not change any law around disclosure. So are we going to have to think through, what the rules are around disclosure during a crisis moment to give some sort of protections?
So there already are protections in the U.S. law for people that state things to the best of their knowledge and truthfully and so forth. But I'm just going to say this in the U.S. Here's the thing. There's 8 U.S. globally systemically important financial institutions out of those 29. Here in the U.S., that conversion of debt to equity doesn't happen on that Monday. It's
right.
A different structure. Here, it happens later, but the holding company is put into, I'm not going to get the proper term, but some form of
some type of receivership.
Some type of receivership, I'm sorry. And then a new bridge financial company, right. and then a bunch of subsidiaries are moved over.
Right.
There's a need to disclosure because the remaining debt holders and the remaining equity holders in that company in receivership need disclosure within 4 days under the law, but I would say give it to them the first day. But also, if you move any big things over, if you move a big subsidiary over that is accessing the markets, that is still has swap counterparties, still has other counterparties, you've got this uncomfortable choice, Roger. That's what I would be telling you.
Yeah.
You want this to be successful over here. You want this
right.
broker-dealer to still have customers. Those customers will run if they don't get some slide deck presentation on Monday morning that tries to answer what are your pro formas, what's your business narrative, who's running the joint, and do you have government support?
All right, so let me ask my last question before turning to the audience. Your focus is on private sector actors should disclose what they know. In our most recent crises, we've also seen a heavy burden on government officials to disclose what they're thinking. And that also is a moving target because the government sector says something, a government official, the market reacts, the government official comes out the next day saying, oh, you misinterpreted, this is what I meant. So how do you as a leading government policymaker in a crisis think about your obligations to disclose what you might do and might not do?
It's an important question, but it does come back to the markets will demand to understand the nature of the government support, whether it's from a central bank
or Treasury
or wherever that support. It's not, the SEC doesn't have, we don't have a balance sheet. The others have, balance sheet to support. But so it will be between that private sector company that's getting restructured and whomever is providing the support to decide the nature of that support and how to describe it to the public. It needs to be accurate.
But we've also seen in the most recent crises, not, as you say, directly not on the SEC, but other government officials finding themselves drawn into making more and more definitive statements when maybe they prefer not to. And you sit on the President's
I
Working Group.
understand, and
those
are challenging times, no doubt. They are challenging times where government officials, whether it's in our country or other countries, are also, there's new information coming in every day. Like there's new data, there's new information, and so forth. But I don't think that takes away the importance that markets will like to understand in this restructuring. What does it mean for uninsured depositors?
No, absolutely.
What does it mean for the counterparties and the swap holders and so forth? And, you know, just a couple weeks, and this is all public, what I'm saying, a couple weeks after Credit Suisse announced the merger with UBS, you saw credit default swap spreads moving out in certain other European banks. And I believe that those banks were wise, that they put greater disclosure. They leaned into some disclosure to make more information out there to, you know, answer some of the important questions that market participants had. I certainly got my share of phone calls from regulators in Europe and in the US about those widening credit default swaps, because we oversee those markets. And I got calls also after the regional bank, the Silicon Valley Bank, from market participants and policymakers about, would the SEC consider putting some short-term prohibitions on short selling, which I don't think would work. Unambiguously, we've tried that. We've been down that road, and it doesn't work. Markets will find another way to express their negative views. If you ban short selling here, the markets will be really brutal somewhere else and find a way to, and that's what really happened when we tried it here in the US once in 2008. So I think it's the best way is, frankly, to be prepared, as these companies have tried to prepare, to have this loss-absorbing capital, but then also be prepared to know who you're going to send to the bunker to do some relevant disclosures as best you can in a human exercise to speak to the questions of the markets.
Okay, but you would agree with me that during those moments, because we've been in both of us, maximum uncertainty limits the ability to say things that are very concrete and may, in fact, open you up to, you know, second guessing.
Uncertainty is high.
Right.
There may be the lawsuits in the future to come.
Right.
So you definitely want to be careful not to mislead the public. But I think that doesn't lead you the luxury of saying nothing. I just don't think that luxury sits there in that moment for the company.
Okay. Let me turn it to the audience. Are there any questions? We have our mic here. Feel free to raise your hand. Economists, policymakers, people just generally want to. Please, go ahead. Take a moment to introduce yourself. And
Bridget Neal from EY. Great to be here, and what vast experience we have with you both on the stage. It's too tempting to not ask you maybe a forward-looking question. I think.
A what related?
Forward-looking question.
Please.
We, of course, regulate and legislate crises in the rearview mirror, and we've put a lot of architecture in place over the years, and both under terms that you've served. I mean, think about the Financial Stability Board, the President's Working Group, and so many different important measures to help the government move swiftly. So if we think to the future, what's missing? The next financial crisis, we all want to have a crystal ball, but what's the next architecture? What's the gap that we might not be thinking about?
It's always the unknown unknowns that are the hard things. You're right. But I think under Secretary Yellen's leadership, I saw this happening during that spring or late winter, spring of 23, and under leadership in some other events, you know, as Russia was going into Ukraine and so forth. Some cyber events that Financial Stability Oversight Council, you know, we have our regular formal meetings, but then in the midst of stress that she pulls us together, I think that works reasonably well. I mean, the lines, the dialogues work well. We do some tabletop exercises as well with our European colleagues, and we kind of think through crises and tabletop exercises. I think this disclosure piece, I'm giving a speech for a reason. I think this disclosure piece is important enough that I would hope that it would be sort of more embedded by the lawyers, accountants, EY, you know, that when you think through, as you're advising, Ernst & Young probably has a number of these 29 as your clients. Hey, how can we be helpful? Because you don't want to just call us up when the weekend hits, you know, if that CFO is even going to keep having their job, but you know so I think of it in terms of just a disclosure is part of the solution. We better prepare for the disclosure piece of this. But Roger, what would you say? I mean, you've observed it.
I've observed it. Fortunately, I'm no longer in markets the same way. But one thing I have observed is you know, the mechanisms, modalities of information exchange are totally different from, you know, almost any other crisis. So now, how do we think about social media and tweets and, you know, that set of things? Where do they fall into this question? The whole notion of social media and books and records, right? So now, you well know the SEC is regulating, you know, the use of LinkedIn and other ways for communication. So one of the things I would imagine today's policymakers should be thinking about is the speed with which information is transmitted and, you know, the new modalities for doing that. Frankly, the other thing that's on my mind is there are actors in markets, call them state actors, neo-state actors, et cetera, that perhaps have incentives to put disinformation out there. You know, so how do you think about that, right? During many of the crises, there was talk later, oh, so-and-so, you know, back to short selling, you know, put something out because they had a short position. So, you know, it's a world that, to my mind, is no longer about what's in, you know, the famous newspapers of the day. It's, you know, other places. You know, is the 4-day requirement for an AK sufficient in a world in which, you know, information is moving in nanoseconds?
I mean,
and frankly, money can move in nanoseconds to some degree. So for me, it's this recognizing the speed with which this stuff happens is no longer over the famous weekend. It could be, you know, much shorter periods of time.
Yeah. I mean, to Roger's point, I mean, in Silicon Valley Bank, we know it didn't make it to the weekend. I mean, you know, having had a fair amount of experience about this from my Goldman Sachs days all the way to my current professional life, you generally, for whatever set of reasons, you generally could limp towards the weekend. Excuse the market, you know, you could kind of, and that couldn't in part because of the things that Roger just raised, that the news cycle is 24 hours, and that information is there all the time. The credit default swaps, the debt markets, the equity markets can trade 24 hours. I mean, we have the listed period here in the US, but you can trade US equities overnight, you know, throughout Asia and elsewhere. And then the uninsured depositors can run. And yeah, and you know, in the US, we have 17, 18, our whole banking system's $23 trillion, $23.5 trillion right now. Our whole capital markets is about 120 trillion. So our capital markets of the US are 4 or 5 times larger than our whole banking system. But our whole banking system's 17 or 18 trillion dollars of deposits. Money markets are 6.7 trillion as of about a week ago. These are all public figures. So you're sitting there and you are confident and relying on your bank, and you've got deposits in your bank, and then something like happens in Silicon Valley, and you're an assistant treasurer somewhere, and you say, I'm going to move 100 million of deposits out of this bank, and particularly in the Eurodollar market overseas, it's uninsured. It's multiple trillions of dollars. Move it around because of uncertainty, or because the credit default swap spread blew out, went up 3 or 4-fold, and you're just going, I don't know. But I do know this, I might lose my job. And there's this asymmetry of incentives. When you're like me, I was the partner awake, and all the other partners were sleeping. But now you can move more quickly.
Absolutely. And we saw it in Silicon Valley Bank. It was, so, it's the speed with which things unfold. I think the other thing that's, at least in my mind, is, Congress sees how regulators, central banks, treasuries dealt with the last crisis, figures out what they like and didn't like, change the regime, so to speak. But we haven't tested any of the new regime against a crisis. And so, to Gary's great point, thinking about what the private sector can do is really critically important. I'm afraid it falls to me as a timekeeper because we're scheduled to end at 10:15, and here it is 10:15. So if you will join me in thanking Chair Gensler for a great speech, great Q&A, and most importantly for being just a great policymaker. Gary, thank you so much.
Oh God, you're so kind. Thank you, Roger.
Thank you. Good.